So I see people coming in.
Yep.
We'll just give it a few moments for more folks to join. All right. Very good. Shall we get going?
Yeah, let's do it.
All right. Good morning, everyone. Welcome to AllGen's quarterly updated market review. First one of this year, 2023, excuse me. I almost forgot what you were in. And we're excited to share a bunch of stuff. It was an interesting 2022. Jason will go into it a little bit later, as always. But we are eager to just share with you what's happening in the economy, what's happening in the markets, what's happening and some national legislation, and what's happening at AllGen. So that being said, we're going to go ahead and here's the agenda for today. Again, Jason will, after we're done with a quick fun poll, as always, to get you guys engaged. We'll be introducing all that stuff. As you know, we always like to field questions. There is no raise hand feature, but if you have any questions, please feel free to hit the Q&A button at the bottom there, and the box will show up and it will field the questions. We're going to try to reserve all questions till the end so we don't interrupt the flow of, unless I see this burning appropriate question that needs to be done when Jason's speaking, we will try to reserve it to the end. But we will, as always, promise to try to get to all your questions during the session. Okay, so that being said, let's go ahead and move on. I want to get you guys engaged with maybe a little poll before Jason gets into the stuff. So a little fun stuff first. Which two teams do you think are going to the Super Bowl? And you may not have an opinion. That's okay. Just you can pick two at random or not participate at all. But feel free to just pick a couple of teams there. And we'll just give you a couple of seconds to pick your two teams. Someone had mentioned, oh, I don't know who's AFC and who's NFC. That's okay. Just pick two teams. It's all right. All right. So let's see. We should have some answers here. What the survey says. Whoa, we've got the Bills. Okay, that's not surprising to me. The Jaguars and the Eagles and the Giants are all tied in people's opinions. That's very interesting. Very interesting. I'll reserve my personal opinions because it don't really matter much here, but okay, very good. So one more question, a little bit more serious note. I mean, football can be serious as well, but a little bit more money related question. So do you think we're in a recession? And you can pick one of the following. Yes, I think we're in a recession now, or I think we'll be in a recession soon, or no, I don't think a recession is coming at all. So I'll give you a few seconds to answer that question, get your thoughts. All right, survey says, oh, interesting. So 46% says we're in a recession now, and 38%. So most people think we're either in it or it's coming, with a slim margin thinking it's not coming at all. Very good. So Jason, I'm sure you'll address that in your commentary. So yes. Let's get to it. Jason, take it away.
All right, very good. Well, for recording purposes, today is January 19th, 2023. And just want to look at the markets and kind of start here with a review of 2022. So all of these squiggly lines here represents different components of what we would consider a diversified portfolio. So you can see like the S&P 500, which is the purple line. That's large US stocks. And then the orange line here is the S&P 600 small cap stocks. And the green line here is the international and emerging market index. And then you have the blue is the bond benchmark. And as you can see here, the worst performing of all of them was the S&P 500. The best, if you want to call it best, the least worst was bonds, down 13. So, and then you had international, which was the best of the stocks, and small caps leading large cap US this year. So this is unique. Last year was a very unique year because you didn't have any real separation or difference in correlation, if you will, between stocks and bonds. Everything pretty much went down together. It was a very difficult year as a portfolio manager because typically you would go back and forth between bonds and stocks depending on which direction you thought the market was going to go. And that just didn't work last year. So that's just kind of a quick overview of the different main indexes and the returns for 2022. And then we look here these are the different benchmarks. So kind of using those main indices, market indices, stock and bond market indices, and combining them into different benchmarks, like an aggressive benchmark, which would be about 90% stocks and 10% bonds, all the way down the conservative benchmark, which is 30% stocks and 70% bonds, and everywhere. And the other two are right in between that, moderately aggressive and balanced benchmark. So as you can see here, not much difference between an aggressive benchmark, which was down 16%, and a conservative benchmark which was down 14%. So that's not normal. And typically, like I said on the last slide, in a bad market year, your conservative portfolio will hold up much better than aggressive portfolio, but not the case. You know, we had some clients last year asking why, you know, their conservative account was down as much as it was, and actually it did pretty well, but comparatively speaking, I'll show that on the next slide, but it was an anomaly year. This year for conservative accounts was actually worse than the Great Depression, the worst year in the Great Depression. And it's because it was one of the few times where you had stocks go down really bad and bonds go down really bad. So it was a really difficult year, especially for those accounts that were more balanced and conservative, that had more bonds, that are not used to this level of a drop. It was really, I mean, it was worst time in the last 100 years for a conservative portfolio and for bonds. So what we're looking at here is these are our accounts. We have two different models. We have kind of two different tiers, if you will, a dynamic tier, which is mainly our portfolios that are mutual fund and exchange traded fund, no individual stocks. And then we have our top tier portfolio, which are for accounts over 300,000, which is a combination of individual stocks, also some mutual funds and exchange traded funds. And then you have those same benchmarks I just showed you on the last screen over here on the right. And you can see here in all the great green areas here, our portfolios, their aggressive portfolio beat the benchmark, and even moderately aggressive and balanced. The only one that didn't beat the benchmark was our dynamic conservative portfolio, which was pretty close. And as you can, and just so you know, these numbers are always net of our fees. So we take the returns of the portfolio after all fees. It's the most ethical way to show returns. Now, this is a median return of all of our portfolios that are in each one of these models. So your returns may vary up or down slightly from this, but on average, this is where our portfolios returned for each one of the different tiers and risk profiles. So as you can see, compared to the benchmark, we did outperform the benchmark pretty significantly. That being said, it was still a really difficult year. And especially for conservative accounts, not just our conservative accounts, but conservative accounts in general, it was a really, really bad year. But let's kind of focus in on first, what did we do last year that helped us outperform? And then we'll get into kind of where we see the market going into 2023. Well, there's a little bit of a busy chart, but it says a lot on this chart. And what we're looking at here is basically growth versus value. When this line is going up, value stocks are leading. When this line is going down, growth is leading. And you'll see a pendulum over time. This only goes back a little over 20 years, but if you went further back in time, there's a pendulum that swings back and forth. You'll have growth that'll outperform for a period of time, and then you'll have value outperform for a period of time. And you can see, coming off the late 90s over here, going into early 2000 through 2008, value did much better and significantly outperformed. And that was after that dot-com era where tech stocks and growth stocks did really well in the 90s, and then value really outperformed. Then you enter this period around 2008, where from that period all the way to 2021, where growth stocks really outperformed value stocks. However, this year, as you can see right here, in 2022 especially, value really outperformed. And from a technical standpoint, value has broken into a new uptrend compared to growth, where value is starting to now outperform. And we believe not only that's one reason why we outperformed last year is because we overweighted value, but we believe this is also a trend that will continue to go forward for quite some time. So, part of doing well and managing money well, whether you're doing it on your own or whether it's us managing it for you professionally, is not only what you own, but it's what you don't own. That's super important, because the tendency is to follow the most, the thing the stocks that get talked about the most, or the investments that get talked about most. And kind of after the pandemic or during the pandemic, when technology stocks went up a lot, stocks like even like an Apple or an Amazon or Tesla or Meta, which used to be called Facebook, and even Bitcoin, those were super popular stocks and investments. But last year, these areas really got hit hard. And we saw a lot of portfolios, and even some portfolios that moved over to us that we started managing, that were very overweight growth. This would all lean in that growth area. And so that's why you can't invest looking into a rear view mirror. When you look to invest, you always look at what you think is going to outperform going forward, not always what did best in the past. This is what did best in the past, but you can see what happens at some point, especially once they get extremely popular, like they were in 2020 and 2021, how much they have the tendency to drop. I mean, you can see some of the worst of which, Bitcoin down 65%. You had Tesla down 65% and Facebook down 64%. Even the bellwether Apple was down 26% last year. So, we tried, this is in 2021, late 2021, we really started reducing our growth stocks and investing more in our value stock, in value stocks in general, which held up significantly better in 2022. I threw this chart in here just to kind of say, from the standpoint of how we outperformed last year, we had to really get creative. Since both stocks and bonds went down, we had to look in other areas. And this purple line here is commodities. So you can see commodities in the first half of the year did really well. So that was something that we also had in our portfolio. And then the gold line here happens to represent gold. And so that also held up significantly better, especially the first half of the year. So holding those two asset classes really helped. I threw this last one in here, even though we didn't own much real estate, but we always get questions about real estate. Last year, real estate got hit really hard. It was down almost 29%. And so, when you think about the world of kind of alternatives, commodities did really well. Real estate, when you look at investing in it inside the stock market, which would be REITs, real estate investment trusts, or home builders, companies that represent kind of the real estate market, they tend it tends to lead what's going to happen in the real estate market, like home prices or commercial buildings or industrial prices in the future. So we think, since stocks tend to be a leading indicator, it's pointing to real estate also starting to decline going forward. And a big part of that is interest rates got up so high, and it made it unaffordable for a lot of people. And I'll get into a slide about that in a little bit. So I want to take a look at the kind of four main components of the market, looking first at the large US here from a technical standpoint. When I say technical, I'm talking about charting and trend analysis. And it's one of the tools we use. It's not the only tool we use, but it's one of the tools we use to kind of gauge where we think the market is going. And so this is looking at the S&P 500, and you can see it had a really strong uptrend since the pandemic low. And then afterwards, it peaked in 2022 it peaked at the end of 2021. In 2022, started a downtrend. This red line here represents a resistance line, trend line, and then the blue line represents a 200-day moving average. And you can see, as of now, we still haven't broken out of that downtrend. So using technical analysis from the purest sense, we are still in a downtrend. And the thought process is we're going to continue into that until we break out above this trend line and this 200-day moving average, which it tried a couple days ago, but it failed to get above that. So we're still in the thinking that we're in a downtrend right now, and we're going to continue to stay defensive, especially in that area, until the trend actually changes. And so this is looking at small cap US stocks. And a similar type of scenario where it had a really strong 2020, 2021 coming off the pandemic low, and then peaked a little bit earlier actually in late 2021, and has been in a downtrend since. Now, it's actually got above its 200-day moving average recently, and is also attempting to break this line. It still hasn't broken it yet. And to kind of determine a trend in technical analysis, you look for, if it's a downtrend, you have lower lows. So each low is consecutive low is lower. And then you also look for lower highs. So consecutive lower low and lower highs would be a downtrend. And the opposite is true for an uptrend. So you have this low right here, and then the most recent low, that's a higher low, that's a positive sign. But in order to make a higher high, you have to make it above this dash line here, and it hasn't done that yet. So I'd like to see it make it above the dash line, and I'd also like to see it make it above this resistance line. Until it does that, we're still going to stay defensive, but it's getting very close, and we're ready to go more on the offensive if we see that trend line break. So there is pretty interesting, though, that we're looking at international and emerging market stocks. They were downtrending in 2022, just along with everything else pretty much. But recently, it did break out from its downtrend. So not only did it break out from this trend line, it also broke above this 200-day moving average. And you can see it made a higher low. And it also made, there's the previous high, it's now above that high. So it's technically in an uptrend. So there was a trend reversal there. So that is a theme that we've been talking about for a while, but has been recently confirmed that we believe international and emerging market stocks are going to outperform going forward. I'm going to give a little bit more evidence on that from a fundamental perspective in a few slides from now, but technically it looks a lot more positive. And then this is bonds. So bonds had a very steep downtrend and had a very rough 2022 and even had a slightly negative 2021, but took a major hit in 2022. However, it has also broken from that downtrend line. And you can see it also made it made a higher low, and it also has made a higher high, and it broke above its 200-day moving average. So we believe bonds have started a new uptrend, which is a very welcome sign, especially for a lot of conservative and balanced investors. All right. So the theme of last year, and the reason why bonds took a big hit and the market took a big hit, is that we had really high inflation. I got a bunch of lines here, but basically all of these are different inflation indicators. Okay, you got just the kind of the U.S. inflation rate, what would be called the CPI, core inflation, PCE, and producer price index. So 3 different types of inflation indicators. The reason I point them all out is just to say there is consensus that inflation, the growth of inflation, has peaked somewhere between March of 2022 and September of 2022, and they're now trending downward. So still extremely high, or historically high, not extremely high, but it's historically high. The Fed's target is 2%, which is this dash line here. So you see, we have a ways to get back down to that 2% target rate. But I think the Fed is pleased to see that it is trending in the right direction. So they're starting to slow down the rate at which they raise rates. And I'll point that out in another slide here shortly. One of the big problems, though, is a tight labor market. And this is one of the most sticky areas of inflation. This is what causes inflation to kind of linger for a longer period of time. Sometimes you'll see oil, and like last year we had oil and a lot of commodities spike up really high, but then they came down pretty quick. So those types of inflation pieces, commodities, can be a lot more volatile. But when you have wage growth in a very tight labor market, which causes wage growth, then if people are making more money, they tend to spend more money. So that can cause inflation to linger for a longer period of time. And you can see in the 1970s timeframe, that was a high inflationary time. The blue line here, which measures wage growth, was above kind of that 6% area for a significant period of time. Which was very fast wage growth, which caused inflation to stay along for a long period of time. we did briefly get above that 6% part. It is now coming down some, which is good. It's still not below its long-term averages. However, you can see here the gray line represents the unemployment rate, and we still have a very low unemployment rate. So unemployment is at 3.5%. Wage growth was at 5%. That 3.5% represents one of the lowest periods in history. So if there's not many people unemployed and there's a lot of job openings with not as many people looking for jobs, employers have to pay more to attract people to come over. And so, and if employers pay more, that means not only does the population earn more, which seems like a good thing, but then they spend more, which causes inflation to go up. So if inflation is higher than wage growth, you're actually not benefiting, because then the growth of your wages are not going up as much as the growth of the prices of everything. So we'd like to see, I think that's going to be an area that the Fed continues to watch very closely, not just inflation come down, but is the underlying condition, underlying cause of inflation starting to get better. And I will say it's trending in the right direction, but we're not quite there yet. Unemployment's still really low, and the job openings are still very high compared to people looking for work. All right, so I threw this slide in here as well, just to kind of point out another area that I think is going to be a problem going forward, and that's housing affordability. And so which is a big component of inflation. So especially if you look at the CPI, it's about 40 to 45% of what measures inflation. And so if it's expensive to pay for your housing, that means you have less money to spend in other areas. And since we're, especially in the US, a very heavy consumer-based economy, if we're spending less, that's bad for the economy. And so right now, looking at home affordability, when this line goes down, it's less affordable. So now we're at a level that we haven't seen since kind of the 80s in terms of affordability. And that's because interest rates have gone up so much. So mortgage rates are 6 and 7%. So, and vacancy is still actually pretty low. So that doesn't look to be improving much. It is starting to go up a little bit if we were to zoom in right here, but it's still historically pretty low. So a lot of pressure to keep prices kind of where they're at, but especially from a rental standpoint. However, eventually, as rates have gone up, now we're starting to see home prices come down, which is what we're looking at here on the left side of the chart. However, these numbers are a little bit old. We got to get some more recent numbers that need to come through to kind of show where the housing prices are. But this is looking at the US, the purple line, and since we have a lot of clients in Florida, the orange line is looking at Florida. And over the last, really since the pandemic timeframe, housing prices have gone up crazy amount. But as you can see here, this trend was very sharp going up. It is now starting to level out, and this only takes us to Q3 2022. If looking at some of the other numbers that kind of measure housing prices, it's starting to actually come down. So that is a good sign from the standpoint of housing affordability. It may be, something to think about too, if you own a home or own multiple homes, and it could be a thought there. If real estate prices go down, is now a good time to sell my home possibly, but that obviously depends on your situation. You should consult your advisor about that, but just something to think about. All right, so jumping into where the Fed is going. Okay, so I'm looking here at the target rate probabilities for the end of the year, the last meeting of the year, which was December 13th, 2023. And these numbers represent the probability of where we're going to end the year at. Currently, we're at the 4.25% to 4.5% range. The highest probability to end the year is 4.25% to 4.5%. So while that is the same, so basically we're predicted to end exactly where we started the year. However, it's leaving this is not the full picture. So what will most likely happen, and what we believe the highest probability right now, is we're going to peak in March at 4.75% to 5%. So we think that we're going to go up 2 more quarter percentage point raises, one in February, one in March. We're going to peak at that point, and then it's going to kind of go flat for a while, and then rates will start to go down in September, and then we're going to end the year back to where we started. So a lot of things can change between now and the end of the year. And we're just showing this as kind of a baseline of what we think is going to happen. Things could change, but because of what's going on with this, you have to kind of think about, especially from the standpoint of investing in bonds or the stock market, when rates are going up, the Federal Reserve is trying to slow down the economy, and they're doing that to try to slow down inflation. When rates come back down, they're doing that because they think that the economy needs to be stimulated. So that means that the Federal Reserve thinks they almost got inflation under control, but if we're going to go up initially and then come back down, then the economy is going to need to be stimulated towards the second half of the year. So what that has caused is a inverted yield curve. And so an inverted yield curve, not to get too technical here, but a normal yield curve, you have short-term rates that pay a lower amount, like 2-year, 5-year rates, even 3-month rates, those pay a lower amount. And then you have your 10, 15, 20, 30-year bonds paying a higher amount. So the longer you go on the curve, or the longer time frame out, the curve would normally go up as you get longer term. But now we have the opposite. Short-term yields are paying higher than long-term yields. And so the 3-month Treasury is one of the shortest ones versus the 10-year is what this chart is looking at. It has gone into what's called an inverted yield curve. The horizontal line represents 0, and then when it turns red, it's inverted. Every time the yield curve has inverted, it has led to a recession. And we love this indicator because it tends to give you a clue prior to the recession happening. So when it first goes inverted into where it goes to a recession, you can see, it gives you some lead time prior to a recession every single time. So we like leading indicators as opposed to lagging indicators, because a leading indicator gives you a clue so you can prepare ahead of time. And so we do believe we're going to go into a recession, and there's a good chance we're actually already in a recession. A lot of times, the people who call recessions officially from the government are late on their call, and they backdate their call to a prior date. So we could already be in a recession. But what does that mean in terms of what we're doing? And I'll get into that a little bit more in a second. But so you got one thing, which is one way that the Federal Reserve kind of tightens by raising rates, and then they stimulate by lowering rates. And then you have another way that not only the Federal Reserve, but central banks around the world also try to tighten through what's called quantitative tightening and quantitative easing. So quantitative easing is basically where you print money and buy bonds. It's meant to stimulate the economy. We won't get into the technicals right now, but when you do quantitative easing, it's meant to stimulate the economy. So when this line goes up, like it did here in 2020, or as soon as the pandemic started, that's when central banks around the world pumped a ton of money into the market, which is also was a good reason why that we probably are seeing the inflation that we did over the last year. So they pumped a ton of money in. They needed to get the economy going. They needed to kind of get through all those government shutdowns. But now, over the last year, we're starting to deal with the ramifications of that, which are inflation. So now they're reversing and they're doing quantitative tightening. So as you can see, this dashed line is going forward, a forecast, but kind of where we're at right now, the Federal Reserve has already started tightening. They started tightening last year, but the European Central Bank is about to start to tighten, and they've really, they're getting very close. The Bank of Japan, the same. The Bank of England has already started tightening. So we've gone from a very stimulative environment, which is very pro-growth, kind of 2020, 2021, when they were pumping a ton of money in, to now they're doing quantitative tightening, which is the opposite of quantitative easing. It's basically when they make money disappear instead of printing money, and that is destimulative. So you have a couple forces here. High interest rates, raising interest rates, and quantitative tightening that are destimulative. Okay, so that's, you're trying to fight an uphill battle right now. The market is trying to go up when we're in a very or this type of tightening environment. So something to think about, and something that we're that we're aware of, and so we can prepare and build the portfolio that matches historically when we've entered these timeframes. So I'm looking at a chart here of the dollar. And the dollar is very important to look at for a number of different reasons. And so one of the big things about the dollar is if the dollar is strong, a lot of times that means international stocks will underperform. As the dollar starts to get weaker, international stocks will start to outperform. So and the dollar is very much correlated with monetary policy. So if interest rates go up, and you're in a stable country like the US, have a stable currency, the rest of the world sees that we have a stable currency and our interest rates are much higher, money flows into the dollar. That causes the dollar to go up. So when we've tightened and we've raised interest rates, that's caused the dollar to get stronger. But now the dollar, it looks like, is anticipating that the Federal Reserve will stop raising rates and start to lower rates, which would then weaken the dollar. But you got to remember, markets forecast the future. They start to discount the future and they start to act in advance of what's happening. So you can see the dollar peaked last year around September, and now the dollar is actually broken its long-term uptrend. And so it's now starting to come back down, which could also kind of back up the thinking that international stocks are a good place to diversify into, to make sure you have some. If the dollar goes down, that could be good for international stocks. And that's what this chart right here is looking at. Very, very similar to the growth versus value, but basically this one is taking international versus US stocks. So if the line is going up, international stocks are leading. And if the line is going down, US stocks are leading. And kind of similar to value stocks, during 2000, 2008, international did really, really well. But from 2008 all the way till basically 2022, you had US stocks that really, really outperformed. And over time, this also has the pendulum effect where you'll have international stocks outperform for a significant period of time, close to 10 years, and then you'll have US stocks outperform for 10 years. We've been talking about, we think this trend is going to change, and it has, from a technical standpoint, point of view, it's broken its downward trend line, and there has been a trend reversal. And so now international stocks are starting to outperform. And that is also, we kind of look at what's called the weight of evidence, where you have a bunch of different things that line up to kind of point to a similar outcome. And with the dollar getting weaker, that's one thing. I'll show you valuations here in a second. That's another thing. And then from the trend standpoint, a lot of things leading and looking like you're going to see international stocks outperform US stocks. And that's important to note because it's been a long time since that's happened. And a lot of people have gotten very used to kind of holding a very heavy US focused portfolio. And sometimes you'll see portfolios 80, 90, even 100% US stocks. But the US only makes up about 25% of the global economy in terms of GDP. And so it is important to be diversified. And there are times where you should have a higher weighting in international, not necessarily higher than the US, but a higher than normal weighting in international stocks. And I think we're entering into that time frame. So this just points out, and I've showed this over the last few webinars, that the valuations of international stocks, basically this gray line points out a discount of a price from US stocks to US stocks, from international stocks to US stocks. And as you can see here, in January, most recently, it was a 27% discount. So international stocks price to earnings were 27% lower than US stocks price to earnings. And, it's at a second standard, two standard deviations. So that is very undervalued based off the history. The history is about a 14% discount. So that's another thing that leans to saying that international stocks will most likely outperform. This chart on the right here shows dividends. When dividends are high, that shows a fundamentally good value. And compared to US stocks, international stocks pay a much higher dividend compared to long-term averages, which also points to good valuations internationally compared to US stocks. The last chart here I want to show from the international side of things is that, looking at China, China is a very important country to really pay attention to. And they're the second largest economy in the world. The US GDP is about 25%, China's around 20%. And so in 2022, you had the gray line represents 2022. You had a recession in China. You had they had a zero COVID policy. They didn't really let anyone out, if you will. They really tried to have no COVID, and that really hurt the economy. Well, they're no longer under that policy, and they're reopening. And so 2023 China should have the fastest growth of the major economies worldwide. And that's important for multiple reasons, not just that Chinese stocks may be a good investment, but if the global economy does well when China does well, which is typically the case, especially emerging market stocks, then if China is going to rebound, that should be good for the global economy. But at the same time, that should help international stocks. And if you look here on the right side, it's looking at valuations. The purple line being kind of 25-year average, the gray area being the range over the last 25 years, and the blue portion right here is the current valuation. So US stocks are getting closer to their long-term averages, but if we look at a lot of international areas, like Japan and Europe especially, significantly under their long-term averages. Emerging market, still from a nominal level lower than the US significantly, but closer to its long-term average, and China is below its 25-year average. So international stocks are at a bigger discount, if you will, compared to US stocks and compared to their own historical averages. All right, so one other thing, I won't spend too much time on this, but this isn't a large part of our portfolio, but we do hold some gold. And this is looking at a really long-term chart of gold. It's showing that it's been in a longer-term uptrend, and we believe that long-term uptrend is still in place. It's also important to look at when you're comparing to the dollar, because a lot of times gold will go up. Gold's the purple line in this chart, and the dollar is the orange line here. And you can see when the dollar gets weaker, gold tends to go up. So if the dollar is going to continue to get weaker, gold may also be a decent piece to have in kind of overall diversification of your portfolio. All right, so the last component here, one of the last things I'm going to touch on here are bonds. And so I've pointed this chart out in the last couple of webinars, but it's really important to note this because I think this is one of the bigger opportunities of 2023. And so if you can see what this chart represents, the gray lines represent where the bond market ended the year. And then the red line looks at, or the red dots here, point at the worst time of the year, intra-year. And you can see the worst point in prior to last year was down 9% for bonds. But last year, bonds were down 17%. The worst calendar year return in the last 50 years prior to last year was down 3%. Last year was down 13%. So that's why, when people look at their portfolios, especially if they're a conservative account, and they're wondering what happened, this is what happened. Bonds had one of their worst years of all time in US history. But that can be a good thing because, going forward at least, because typically when you have really bad years, you have the bounce back year next year. And this year, bonds are already up 3%. And we're not even through January yet. So there's another chart just to kind of reinforce this point, going back 100 years, looking at US government bonds, the worst returns represented by the red area, and then their subsequent bounce back year, the green area. And looking at the worst 6 time periods, and last year was even worse than the other 6, on average, the next calendar year was up 14% for bonds. So we really think bonds should do well going forward. And it's not just based off of historical evidence, but you can already start to see it in its trend, which I pointed out, that shows, that bonds have broken into a new uptrend and they come out of their downtrend. And also that yields are paying much higher. At the beginning part of 2021 or 2022, they were only paying like 1.5%. Now they're paying 4, 5, in some cases even 6% in some corporate bonds. So they're paying a much higher yield as well. Now, the last slide here I'll touch on, there's a lot of things that if you just look at the economy, an inverted yield curve, still high inflation, earnings starting to come down, that would point to bad times to come and from the stock market standpoint, especially in the US. However, we also think it's important to look at sentiment. And sentiment kind of measures, what people's feelings are in the market. And in general, sentiment has been very accurate at kind of pointing out bottoms, especially, and even tops as well. And the way you use sentiment analysis is when people are panicking and people are very fearful, that means they've probably already sold out of the market. And now they're in cash, and it causes a lot of potential demand to buy back into the market. And so historically, when people have panicked, then the market has reached a bottom. And so we're looking at kind of a conglomerate of different sentiment index, kind of a panic and euphoria index here, which is measured by the blue line. If it goes down, it's very panicky. If it goes up, it's more euphoric. Euphoria, it tends to be a characteristic of a bubble and a top in the market. Panic is a condition or kind of more of a characteristic of a bottom of the market. And each time this index has reached a very low point, which it recently has over the last almost 30 plus years, the next 1 year was up 95% of the time, and the average returns were around 18%. So even though things look really bad from a recession standpoint, a lot of other inverted yield curve and all those things I pointed out, plus a lot of other areas, it's from a sentiment standpoint, we need to have an open mind that we possibly put in a bottom. When we first started reaching this panic level back in October of last year, we actually started adding a little bit more to stocks. And there was a rebound in the fourth quarter, which our portfolios actually did pretty well in. And it's because we bought and added to stocks down when the market was panicking. So just keep that in mind. Even though things may sound bad from an economic standpoint, the market is forward looking, and there's also a chance that the market has already bottomed. So we're open to that possibility as well. Well, with that, I'll turn it over to Paul so he can kind of cover some AllGen updates and some financial planning advice.
Thanks so much, Jason. And before I start doing that, I want to just remind you, please feel free to type in any questions in the Q&A box that we'll look to answer for you before the end of this webinar. So some quick updates. Some of you may have heard big legislative changes, the Secure Act 2.0. And if you ever have insomnia, want some light reading, go ahead and read this congressional passing. It's over 4,000 pages. I'm not quite through with it all yet, but there's over like 100 changes that affect a lot of retirement planning moving forward. I am not going to go over those 100 changes today. I wanted to just highlight a few changes that could affect you depending on where you're at in your financial stage in life. One of them is RMDs, required minimum distributions. The age for required minimum distributions was pushed back. It had been pushed back recently at the last change from 70.5 to 72. Now it's pushed back to 73 starting this year. So what does that mean? If you were already taking your RMD at 72, you're unaffected, okay? But if you turn 72 this year, you could technically push it back another year. This might or might not affect you depending on what your plan looks like, your portfolio looks like, but it's very important to know that that's a possibility for some people out there in doing their planning. Another thing that changed, which hopefully never happens to our clients, we try to stay on top of this, but there was a huge penalty if you missed your RMD, right? Remember, it's required, right? The law says we want you to take your money. Why? Because it's a revenue generator. It causes taxes, especially from retirement accounts. Okay, there was a big penalty, up to 50% was the penalty. It was lowered this year to 25%. And then this is the kicker, for IRA owners, down to 10% if remedied in a quote unquote timely manner. And that's usually filing an amended return and within a certain time frame. So know that that's out there. If it happens, we would be on top of it with you to make sure that it's taken care of. Okay, hopefully don't have to deal with that at all because we'll get your RMDs out on a timely basis. Now, another thing is before there was a discrepancy between Roth IRAs and Roth 401k accounts. Roth IRAs had the luxury of, there was no RMD, there was no forcing. And again, we like to have people be in control of their monies. That's why I don't want long-term annuities that lock you, and we don't like that type of stuff. But in employer Roths, you had to take an RMD. Well, starting next year, you will not have to be. So they actually aligned those up together. And again, this is a year out, but it's good when we're doing future distribution planning from retirement accounts that we know that that's a factor out there. So those are three big changes to the RMDs. Another big change that happened this year was the employer Roth matching contributions. Historically, whenever an employer matched your contributions, it had to go to a pre-tax account. That has changed. Now the employers will be able to place matching contributions into a Roth account. You will be able to choose. Do you want it into the pre-tax or into a Roth account? Again, as you guys who've done planning with us know, sometimes it makes sense to do pre-tax, sometimes it makes sense to do Roth, depending on your situation. Now you have the luxury of doing either one. Now, caveat. This requires updates to plans and systems and platforms, retirement plans to be able to have that feature introduced into their plans. So it probably, if you go tomorrow to your boss and say, I want this, we can't even do it yet, okay? But the legislation is there setting the stage for that. So stay tuned if that makes sense for you guys. Another one that's not happening immediately, but again, good to know because this is a cumulative effect, is 529 accounts. You know, those education accounts. For those of us that have children, we've been funding these things to be able to pay for college. So maybe they got scholarships, maybe it wasn't used for that, maybe they didn't go to college, etc. So now, after 15 years of having a 529 plan, okay, these assets can now be rolled over to a Roth IRA for that beneficiary of that 529, which is huge. That's never happened before. Now, I say huge, it's huge as far as legislative passing. Now, it is subject to the Roth contribution limits, which I'm going to touch here in a second, you know, that traditional 6,000, 7,000 limit. And there is an aggregate lifetime limit of 35,000. So all you'll be able to do, quote unquote, all, which was coming from zero, is 35,000. Now, this will be in effect next year. You can start doing this, but again, 529 is usually not a one-year proposition, so it's something to take into consideration when doing planning. Okay, so that's some of the highlights, and we're staying on top of all these, especially as they may impact our clients respectively. Be aware that retirement account limits are up again this year. So for employee retirement plans, you can put up to 22.5 in general as a base deferral. And if you're over 50, additional 7,500. These are all up, both up. Okay, 7,500 catch up, meaning that's a total of about $30,000 a year that you could defer into a retirement account. Okay, if eligible. Simple IRA plans, a little different from traditional retirement accounts, but it's up to 15,500. And if you're over 50, 3,500 catch up, giving you a $19,000 total possible deferral into your account. Okay. IRAs up to 6,500 a year with $1,000 catch up. Okay. And then HSAs, health savings accounts, individual is 3,850 and family is 7,750. Again, these are tax favorable strategies that might or might not make sense depending on your plan. So I wanted to share some of those because of course I lean towards the financial plan. We all lean towards financial planning, and this is where everything that's going on in the economy, we can bring it down to how this affects you and how you can control your economy moving forward. So those are some broad level things. I want to give you some more specific things in broad level. You know, you heard Jason say, hold on, go back a second. Jason talked about interest rates going up, things of that nature. You know, we always recommend emergency funds, right? Emergency reserve funds. And those aren't that, you know, sexy or that exciting, especially historically in the last few years. Oh, I'm earning a great whopping, you know, 0.5 point or 1%. Well, that's changed with interest rates coming up. We're really encouraging people to take a look at where their emergency funds are. And, you know, banks tend to be slow to move interest rates up, but there's accounts out that are high yield savings, high yield checking accounts that are offering upwards of 3. I know we use one at Charles Schwab that's currently offering, I think, 4 or just a little bit over 4%. So a great time to look at where you have your emergency fund because that's a little bit more significant interest to earn. So we're going to, for our clients, we're going to be sending instructions on how to open your own money market at Schwab if you so choose. It's not the only institution, but we want to make that available to all our people to be able to maximize even that piece of their portfolio. Okay. On a different note, on a personal note, we'd like to give a warm welcome to Charles. Charles Steven has joined us. He joined us a little over a month ago. He's a new CSA at AllGen. He's supporting Robert Cortez, financial advisor here, and myself. So we're excited about that. He's got a master's in sociology, a strong desire to help others as from his background. Fun fact, he's a triplet. So if you ever see him around, you can ask him about that. He has some opinions about that, whether it's identical or fraternal. And he is married. If you ever see any bags under his eyes, he's got a 5-month-old son. So, we're excited. He's embarking on that journey with his wife. Okay. And then we have another addition to AllGen. We want to welcome Manny Dudushina, new member of our ops team. He's working closely with Paola and Kristen, to make sure our ops is well supported. He's got a bachelor's in finance background, working as an entrepreneur, and also he came to us more recently from Siemens Corporation. Avid soccer fan, so he and Jason have some interesting conversations, especially when the World Cup just happened. And then he's married with 2 teenage boys. So that being said, I want to then again remind you, we're going to go to our Q&A session. You can still type questions. It's not too late. We're going to get them over here, and let's see. We're going to start. I haven't looked at these yet, so please feel to continue typing. Regarding the Secure Act, what are the advantages of employers not able to make Roth contributions on behalf of their employees? Okay, so here's a good question, and I'm glad actually this was brought up, because understand, before, when they were only able to do it pre-tax, right? So now if your plan dictates that I should have more Roth investments, okay, then now that piece of your portfolio can also be invested in a Roth type of investment. Understand this, it's going to be a little bit different handling, and this is where it's good to do some planning, because before that was pre-tax, so there was no tax impact for you in them making that contribution. Now it's taxable now to you. Okay, so it won't be taxable to you later. That's the whole dynamic of Roth IRAs versus traditional. But that's one of the impacts, that it all depends on, whether it makes sense for you or not, and you'll have to choose. You'll get to choose eventually. It's whether your plan dictates, what tax bracket you live now versus later, and is it more advantageous to have traditional? I'm sorry, Jason, I hope you don't mind. I just jumped into that question since it's a big planning question. Whether it makes sense to have pre-tax versus after-tax monies now and later. Okay, so thank you for that question. Jason, did I answer that okay?
I think so, yeah.
Okay, very good. Another question, now that employee Roth accounts are exempt from RMDs, if I leave the employer and roll it over, do I now have to pay an RMD? Well, no, what's going to happen is if you roll it over, you're going to roll it over into a Roth IRA, and Roth IRAs don't have that RMD restriction. Okay, this is a different conversation. I think we even did a webinar on this, on the 5-year rule. So I was having a conversation with a client this morning. We wanted to open a Roth IRA for them now to make sure that any money's coming over that are not subject to that 5-year rule as far as gains. That's a little deeper conversation as far as planning, but no, you will not be subject to the RMD because it's be Roth. That's where they level the playing field, Roth to Roth. Okay. How long do you think it will take for inflation to go back to 2% goal? Jason, I'm gonna throw that one right back at you, man.
Boy, that's a good one. And I was going to try to find that chart with inflation. There it is. So, I think it's going to be kind of hard for a while. We're trending in the right direction. I'd love to say we'll be there by the end of the year. But I think from a probability standpoint, I think we kind of stay above that for a while. So I think we probably going to bottom out closer to that 3, maybe 3.5% range. And that's going to cause what I think it's going to cause interest rates, not necessarily to continue to go up, but to be elevated for quite some time. And that's one of the main causes of inflation staying high. And the reason why I think it's going to have a hard time going down is the job market is just so tight. There's almost 2 employers for every 1 person, 2 job openings for every 1 person looking for a job. And so until that number starts to get better, you're still going to have higher wages. And when you have higher wages, you have higher spending, which keeps inflation high. And that just hasn't really budged much yet. So I think it's going to be a while. It may take a couple of years, but I think it's going to stay it may kind of level out around the 3.5% range, possibly towards the end of this year.
Very good. And you did touch upon this, but I guess another question to maybe go a little deeper is this: indicators are showing that we're either in or going to a recession, yet you were talking about a high probability of the market going up. How does that make sense?
Well, I think two things. One, the stock market is a leading indicator. So a lot of times the stock market will go up while we're still in a recession and before the recession ended. And we may already be in a recession. So there's a chance the market bottoms and starts to go up during this time. I'm conflicted because you have a lot of even leading indicators pointing to possibly markets continue to decline in the US. But then you have sentiment, which is that slide I showed at the end, which would say that we're have a pretty good chance of going up from here. But to answer your question though, Paul, markets are leading indicators, and they will typically bottom and start to go back up prior to a recession ending because markets are anticipating that end to the recession and better economic times, and they start to go up in advance of that.
Yeah, I think you shared with the team also at last week's huddle that historically, when recessions have happened, markets have gone up, because they've already anticipated the recession coming. So trend has been that when a recession hits, markets actually tend to do better. So we'll see.
On the other end of that too, Paul, that when the market went down last year, anticipating us going to inflation, into a recession.
Right,
so
exactly.
It happens the same way on the other side of things too. It goes down prior to the recession starting.
Right. Okay, and this is a question, I guess, of an opinion. Any thoughts on the fact that we hit the debt limit and now we're having to dip into federal funds to pay our bills? I think that's very recent news. So I don't even know if you're up to speed on that yet.
Yeah, I am. This happened a while back. I think at the end of the day, they're going to come up with a decision or an agreement that they will push through, and they'll allow the debt level to increase. But what will tend to happen, especially when you're in an inflationary time like this, that there's kind of some give and take. So, Republicans now lead Congress, and what they're trying to do is basically, hey, we need to reduce spending. We got a lot of inflation. We have a lot of debt. So we're only going to vote for the debt ceiling to be raised if we start to cut spending a little bit. And so they'll debate about it. They'll go back and forth. I'm sure it'll be a big news thing. But at the end of the day, I think they'll come up with an agreement and they'll end up raising the debt ceiling.
I guess you're not really phased by it right now as far as what we're doing with our portfolios, because we're looking at a lot of other indicators.
It seems like a rolling theme. I remember it happened back in after 2008. I think it was like 2011 or 13. And that one got a little bit scary because it was the first time that our credit rating went from AAA to AA. And there was thoughts of a potential default. I think there's a lot of lessons learned on both sides of the political aisle from that. And I don't think they'll let it get to that again.
Very good. Well, that's all the questions we have here. I always, as you know, we welcome our team, our people, our community to call us, email us, schedule time to meet with us. If you have any other further questions, if you want to review your financial plan, if you want to do a financial plan and to start the year off with maybe some strategic steps to improving your financial situation or taking it to the next level. So thank you so much for joining us, and we hope to see and hear from you soon. Bye-bye now.
Thank you. Take care.